Welcome, everybody. I'm Dave Rubin, Board Chair of the Rural Bonny Doon Association. Welcome to our webinar on the California insurance crisis. We're going to have 6 presentations tonight from various people in the insurance industry or government. And to keep the proceedings flowing, we've structured this as a webinar. Only the people who are invited speakers and panelists will be visible and audible. We've had a number of requests for video recording, and this is being recorded, and we'll post the recording on the RBDA website, which is www.rbda.us. Normally we would start with Supervisor Cummings, but Commissioner Lara is on a tight schedule, so we're going to put him in first. Before we turn it over to him, I did want to say that, as most of you know, or you wouldn't be here, our California insurance market is in crisis, and the crisis is seriously impacting people's lives. We could spend this entire evening going over personal accounts of people who were non-renewed and ended up with appalling choices. Some are paying thousands of dollars more for low coverage insurance, and some people who are lucky enough not to have any mortgages are considering or have chosen to go without insurance. We personally know people who have just finished rebuilding from their houses that burned during the CZU fire and literally have no trees left on their property. And now the only insurance they can get is through the FAIR plan at 4 or 5 times their previous insurance price. So the purpose of this meeting is for our speakers to provide information to our community about what your current options are now, how we got to this point, and what the plans are in the works for relief in the future. And thanks to Eric Ornis, our RBDA Vice Chair, who organized this session and recruited these speakers. So with that, I'd like to turn it over to California Insurance Commissioner Ricardo Lara.
Thank you. Thank you so much. And I appreciate, as you can imagine, this crisis we're in. We are in back-to-back virtual town halls. And so I want to make sure that I actually came and share kind of my thoughts and the views and the plan to get out of this insurance crisis. But you have, of course, the great supervisor, our Assemblywoman, you have Seren from PIF, and of course, Joe Laucher, who used to work for the department, who are all very knowledgeable about what we're doing to get California out of this mess. And, you know, like you were saying, I'm going to get right to it. We are facing an unprecedented insurance crisis that's going to require that we make really bold moves. And right now, as you were saying, people are they're not just shopping for insurance, they're hunting for insurance. Prices have increased nationally. Many of you have had your policies canceled or not renewed. And we need to get back to a point where insurance companies are competing for your business to drive down cost. And there are parts of California where, as we were mentioning, you know, your communities, where insurance companies will not even call you back. And the FAIR plan has become the only option and not the last resort that it should be. And we are all working together to come to create some lasting solutions, I should say, for the availability of insurance for the unforeseeable future that now we, you know, as we tackle inflation that we've never had in the past 30 years and climate change that continues to threaten our way of life. And so I want to be very clear that, you know, I'm your insurance commissioner. I am in this position. I own this problem now after years of neglect, and I'm going to fix it. And I'm making California's largest insurance reform in more than 30 years. And under California's outdated rules, insurance companies are increasing their rates legally, but they're not writing more policies, and that is the problem that we want to fix as quickly as possible. And I want to give you some perspective. California still has the lower rates on the average than many states with major climate risks, including Texas and Florida. But that is, cold comfort for many of you. I know that some people can't find insurance at any price except that in the FAIR plan. Others are losing coverage when they've never even had a claim. And we get it. We have to make insurance more available, which is gonna ultimately make it more affordable. We want to get insurance companies to write back in California, but also not only just write, expand their footprint again in our communities that have suffered already from the devastating impacts of these wildfires. And that is why my sustainable insurance strategy seeks to do. And it's also important to say that, unlike public and private utilities, insurance companies are not churches, they're not charities, they're private businesses and are not legally obligated to provide coverage to everyone. That is the limit of Prop 103 and another problem that we're going to solve with our sustainable insurance strategy that we're fixing by actually engaging with insurance companies, talking to them about what they need to make California, again, a viable option for them to continue to grow and expand. So my strategy consists of several components. I'm going to dive in a little bit, but the conversation that you'll have will be able to explain and kind of go more into depth about some of these issues. Together, we're going to make it easier for all Californians to access insurance once again. So we have real intervener transparency reform. We're going to work on allowing catastrophic modeling regulation. Why is California the only state not allowing the use of technology to be able to look forward-looking models to look at how these fires are reacting? How is climate change affecting us? How is extreme heat now working against and with these fires? We have to also look internally at our rate application process and efficiencies. What are the deficiencies within the department that create such a delay that insurance companies can't get the market certainty to be able to price the risk accordingly? We also have to start looking at California only the net cost of reinsurance. We're starting to look at that. Why is California one of the few states that doesn't allow for us to do a pass-through on reinsurance when we know, and you'll hear this from Seren, reinsurance is quadrupling in price because of all the devastation that's occurring, not just in California, not just in the US, but globally. Reinsurance is tied globally. So we've come up with what I think is a appropriate solution that doesn't tie us to the global market, but that we pay a portion for our risk only for California. So again, being creative of not tying us to the global market, but keeping us only to the risk that we take responsibility for as Californians, which is the risk that takes place in the boundaries of our state. And of course, those of you that are in the FAIR plan, we need to majorly modernize the FAIR plan and make sure that it meets the moment, but that it has appropriate coverage limits, that it has appropriate customer service protocols so that you could get a call back, that somebody can actually offer you a policy, that we get to a point where if you're going to be sent to the FAIR plan, that you can actually have a comprehensive policy option. Those are all changes that we made, and that we also include the FAIR plan as an option for critical components of our economy, like affordable housing developments, home builders, vintners, talking about wine a little earlier, our youth outdoor camps that are losing coverage, our HOAs, which continues to be a big issue. So I expect, and as we talk about all these different reforms, I've committed to the governor, the legislature, to our assemblywoman that I'm going to get this done and have them fully be able to be implementable by December. As you can imagine, that is a major overhaul where we are building the plane and flying it at the same time. But this is what the moment requires. We cannot, we have to, be aggressive. We have to meet this moment, and I'm proud to say that the men and women of the department are with me, and we are going to get this done in time to be ready on January 1 to be able to start looking at these new rate files and start implementing a lot of these reforms. So I expect these changes again to be effect by December. And as soon as the changes take effect, we're going to be open for business, and we will fully encourage insurers to be ready to do that at the same time. So January 1, I want the insurance companies to submit their new rates under the new reforms so that we can get them to start writing in all the different parts of California. So my department is doing our part to be ready. We also are hiring new staff, reviewing rates, and taking a long overdue look at our own internal operations. As I said earlier, we have a diverse market of large, small, regional companies. We need all insurance companies to do their part, and that is what my strategy will do. Under our historic agreement that I reached with insurance companies last year, they have agreed, and they must cover, I should say, at least 85% of properties in distressed areas, while also simultaneously remove policies from the FAIR Plan. That is why this agreement is really historic in nature. Seren can talk about that as well. Sorry, Seren, I'm giving you a lot to do tonight. But it is getting the companies to come back to our community. We need to make our market competitive again so that they are fighting for your business. We know that this is working because Allstate has already said that they're going to start writing new policies across the state when our reforms are in place. Allstate is important because it's one of the largest one of California's biggest companies. That is good news. Farmers Insurance was it's the second largest homeowner and commercial writer in the state, has reopened already its condo and apartment coverage, which is important for us, and as well as the market continues to come back. And once we have the reforms in place, many more companies are going to come back to the market and stay here. So, we all have to work to reduce the risk of these wildfires. The CZU lightning complex fires last year are a stark reminder of the growing intensity and frequency of these wildfires fueled by climate change that are threatening the lives, homes, and entire communities. I don't have to tell any of you about that. And the facts are undeniable. 9 out of the 10 largest wildfires in California's history have happened since 2017. Nearly 1 million acres have already burned in 2024, with months left to go in our so-called wildfire season, which to me, we no longer have a season. It's all year round. And all of that is contributing to higher cost and higher risk in specific areas. So these are 2 things we need to do to bring down the cost of insurance. First, we need to make our insurance more available in all areas, including those with the greatest risks of wildfire. People win when companies compete for the consumers, and consumers have choices. Second, we need to work together to make communities, safer. Driving down the cost and the risk of loss will drive down the rates, because climate change impacts are really accelerating. We need to take action now to expand insurance availability over the next 10 years. So in short, we have been implementing, again, a law that I wrote when I was a member of the state Senate. This measure will keep your home insurance in place after these devastating wildfires. Consumers should not have to worry about insurance while they're recovering, but we know this is a temporary Band-Aid. But, at least it gives time. That year gives you time to reassess, 1, how you're going to recover, and 2, not have to worry about what's going to happen, and ultimately try to bring some stability within the market within that year, so insurance companies are not making rash decisions right after the fire. So what do we get? We have been speaking about statewide efforts. The question on our mind is exactly how are you going to help me, and when will this get better? My answer has been really simple. If you are on the FAIR Plan anywhere in California and you have wildfire risk, the plan is going to help you. If you live in a wildfire distressed zip code or county, there is help for you. And we're balancing the urgency of the situation we face with the need for transparent and public input, which is why it could be frustrating sometimes, because I, by law, have to put all these regulations through a public process, because it would be all in vain if when I get sued, because I will get sued, is that I lose on all these reforms because of the process and not because of the meat and potatoes of the referendum and reforms that we're making. So we made a significant progress in the last 12 months. And by the end of the year, we'll have all the regulations in place that will work for you and for all of California. So we're meeting our timeline. And I'm confident that the strategy will provide and will improve conditions for consumers and our overall marketplace. Why? Because we've had direct conversations with insurance companies who made it very clear that these changes are not only what they've been asking for years, but we're also putting the appropriate consumer protections to make sure that you're protected and make sure we abide by the law of Prop 103 that says that the rates have to be fair, they can't be discriminatory, and they have to be actuarially sound. And that is the work that my department does every day. And I know that these are tough conversations about insurance. Nobody wants to be spending their evening talking about insurance, but we can't be afraid to have these conversations, and we cannot be afraid to ask questions. You know, connect with our insurance experts at the department. I'm going to have Julia a little bit later on. You can reach us at insurance.ca.gov. You can chat with us, file a complaint, or speak to someone directly. We can assist you. You can communicate. You can, communicate with the supervisor's office or the Assemblywoman's office. We are in direct communication with them as well. If you need us to do a specific town hall in your specific community, we can send staff, or if I have time, I would go. We are really committed to having more and more of these conversations. Again, we are on your side. We want to help you understand your coverage. We want to help you understand how these massive reforms are going to overhaul the entire market in California and make us open for business. And, the media keeps asking me, how are we going to know if this is working? We're going to be able for the first time to track quarterly what insurance companies are going back into these communities, because we're going to be able to have that data for the first time, and what homes are being taken out of the FAIR plan and being offered a policy outside of the FAIR plan, which is we know is going to be less costly with more coverage than actually being in the FAIR plan. For the first time ever under these reforms, we're going to be able to have access to this data. So then when the Assemblywoman asks me what district, what zip codes, and what counties are we seeing movement in, I can be able to give her that information. And if we see that something's happening or not happening in certain parts of California, guess what? We're not going to be able to have the data to see and adjust and rejigger our regulations or rejigger our approach. The last thing I want is to lock us into another 30 years of old, outdated regs that should have been updated years ago. And because, as we all know, we all see the newspaper, you all lived it in your own communities. I can't lock us in, and we got to be able to move and maneuver quickly to address and meet the moment. We're talking about wildfires, but every single county in California over the last 30 years has been under a governor-issued flood emergency. We haven't even talked about floods. Of course, there's earthquake. Now there's landslides. We even had a hurricane down here, a tornado in Southern California. So times are changing. We need to be able to appropriately price that risk as quickly as possible. We need to protect our consumers, making sure that the rates are appropriate to the risk. And also, for the first time, you're going to be able to get credit for the mitigation that you're doing, and your rate is going to reflect that now, something that we haven't been able to do because we can't access that technology. So again, rehauling the entire system by allowing us to be able to have transparency, data, and working with the industry, with consumer groups and fire experts to get us out of this mess so that we continue to meet the moment and continue to be the largest insurance market in the country, fourth in the world. Again, not to give any excuse, but this is happening globally. Every single insurance commissioner in our country is facing these issues. But of course, we're going to feel it more acutely because we are the largest market. And so this is why we cannot wait. We have to meet this moment and be aggressive and get this done within a year. I'm sorry I got on my soapbox, but I wanted to really be clear and blunt about the situation that we find ourselves in. And so Again, I just want to thank Assemblymember Pellerin for being a real strong advocate and champion. Trust me, I get her calls. She's asking me what is happening. Continue to send those calls to me, Assemblywoman. We'll continue to reach out to your community and of course to our supervisor. But I really appreciate your time and thank you for having this important discussion and dialogue that we should be having all around the state. So I appreciate your time. Thank you.
Okay, thank you, Commissioner Lara. Justin Cummings, are you online still? Can you turn
I am.
on?
Can you all see
your?
me and hear me?
Yes, I don't see you.
I see him. It's okay.
I was
okay.
kicked off for a sec. So
Oh,
there
there
we
you
go.
are. Yeah, you just popped in. Okay, so thanks, Supervisor Cummings. As I mentioned before, normally we start with Justin giving a very brief update on issues in the county. We rearranged the schedule tonight to accommodate Commissioner Lara's schedule. So now we'll have Justin give his update, a brief update on other matters, and then we'll resume immediately the next 5 speakers on the insurance topic.
Sure. And yep, I'm going to be really brief tonight because I think everybody's really here for the broader conversation around insurance. But I do want to thank Commissioner Ricardo Lara for being here. Earlier this year, we were able to get a presentation from his staff, and as part of the recommendation from the board, is we sent the board directed the chair to send the letter to Commissioner Lara and asking him to come back and speak with our community. And so just want to really appreciate his office's responsiveness, especially to the RBDA and the folks in Bonny Doon as a community that was heavily impacted by the CZU fires. So I'll get to it. Quick update on wood hauling. Just want to let folks know that I appreciate all of your advocacy, because out of the 75 parcels where wood hauling needed to occur, right around the time when I came in office, we're down to 7 parcels, and those are all in the coastal zone. So we are almost done with wood hauling on all of the properties where PG&E fell trees after the CZU fire. So just want to appreciate everyone who reached out on that front, because it really helped us be able to advocate for you all. The Soper Wheeler property, the equestrian center, earlier this summer, we sent out an email after we thought we had a lender who was going to provide us with a loan, and we were starting to gather input from the community about what that property could be. It's the 79-acre property off Bonny Doon Road, and unfortunately, we had heard after July that a subcommittee of that organization had met, and the timeline that we had agreed to, which was around 15 years to pay back the loan, they thought was a little too long, and they wanted to happen within 5 to 7 years, which was not doable for the county. So we were unable to execute that loan for the property. So we're not able to continue to pursue that at this point in time. We are hoping that if there is someone out there who would like to loan us, between $3.5 and $4 million to purchase that property, that we're going to continue to see if there's an opportunity there, so long as the property's on the market, because we do see it as an asset, not only for the people in the community who are equestrians or who are into riding horses, but we also see it as an opportunity to build in some infrastructure around wildfire fighting and fire mitigation on that property, and also see it as a community space that we could explore for future community opportunities for development. The rail trail, as many of you probably see when you're driving up Highway 1, is underway. It's on schedule. We may see some impacts with the winter rains, but it's looking like it's going to be a really great asset for people to be able to, get off of biking on Highway 1 and onto a safe path that will run along the coast. And so we will continue to keep you all updated on that. I'm working with Supervisor Koenig. I'm going to be bringing forward an item on October 8th related to reducing tobacco waste, in particular cigarette butts, in the county. We've spent about 1.5 years conducting outreach, meeting with different groups. We've spoken with some folks from the RBDA, and we appreciate your support. And what we're looking to do is ban the sale of filtered tobacco products within the county. There have been some initiatives at the state that tried to do it, which were unsuccessful, which really, kind of sent the message that starting locally might be the best effort. And the real reason why we're trying to do this is because in the Monterey Bay area, 25%, roughly 25% of the trash that we find on our beaches are tobacco waste, and of that, about 95% are cigarette butts, which are made out of plastic. And as we're all becoming more aware about plastic pollution in our environment, we know that it doesn't break down very quickly. It ends up accumulating not only in the environment, but within organisms. And we know that it can have negative impacts, not only on organismal health, but when we consume it, it has impacts on our health. And so we're really hoping that if folks are supportive of this, that they can write letters of support. We're happy. I'm going to put an email address in here that people write letters to the Board of Supervisors. They can write letters to our subcommittee. And if people have questions, we're more than happy to answer questions related to this, since I don't have that much time to really speak in depth to it this evening. And then the last item, I could talk about more things, but I think that this is relevant to our conversation. I really want to just thank and appreciate everybody from Bonny Doon who came out to speak against the low impact camping ordinance that was before the board, and for all the folks who sent letters in opposition to SB 620. I think that there was some well-intention around not only the statewide bill, which did not pass the legislature, and to the item that was before the board. But as I think when all of us started to learn more about it, and given the impacts of fire that we've been facing, and given the impacts of people losing insurance, there's a lot of concern about the fact that if we expand camping on private property, especially on properties that are unmanaged and just allowing people to kind of go out at their whim and camp, what impact is that going to have on the community in Bonny Doon that's already experienced, devastating fires? Because if nobody's there to regulate it, we know that people will break rules. And in addition to that, what does it mean in terms of increasing risk? Because we know that with insurance companies, they're really looking at risk, right? And if you're bringing in another level of risk, which is unmanaged camping or even managed camping, that not only could have effects on the people who are, trying to use this as a way of, supplementing their income, but it can also have impacts on the neighbors, right? Because if you're in close proximity, that means not only is the property where the camping is occurring risk increased, but it means your property's risk is increased, which can mean that you might get dropped as well. And so I'm hoping that through this conversation, we can learn more about some of these policies that people might put forward at the legislature that's well-intended, but could have impacts on people's insurance and people losing their insurance. And while I've heard rumors that the author might not be bringing this back forward, it's pretty clear that Hip Camp, which is kind of the force behind this, will likely be bringing it back. And I just want to let you all know that I'm going to be on top of it. I'll be reaching out to Assemblymember Pellerin to just learn more about what might be happening at the state level, so that we can be ready to advocate on behalf of a community that is struggling to rebuild, let alone should we be increasing risk that could further lead to people losing their insurance in our community. And so just want to thank you all for your support. And I will stop there because I think that people want to hear more about the insurance stuff than hearing from me right now. So I will leave it there and look forward to being in touch and providing more updates through the Highlander. And please feel free to reach out anytime. I'll leave my email in the chat.
Thanks, Justin. And thanks for your update, and thanks for your work on our behalf, particularly what you did to help defeat the proposed LICA ordinance. Okay, now we're going to get back to the insurance topic, and our next presenter is Seren Taylor of the Personal Insurance Federation of California. And we're running a little behind schedule. We want to have time for the questions. So I'm going to put on my timer, and I'm going to be really rude about this, trying to keep us on schedule. And so, Seren, as you heard from Eric, you've been allotted 15 minutes. If you finish early, so much the better. But Thanks. Go ahead.
Sure, I'm happy to be here and give you as much as I can. And I also want to thank you guys for inviting me here and to the assembly member and the commissioner and the supervisor. And I too can tell you that had some tough, but I think respectful and fair conversations with Assemblymember Pellerin. And I always appreciate her thoughtfulness, even when she's being tough on us. So appreciate the opportunity to be here. What I like to do is, I think this is a very complex topic. The commissioner talked about a lot, like you said, wanted to dump some duties on me to explain, put more, I guess, flesh on the bone of what he was talking about. And so with that, I'm going to try to run through this PowerPoint in the time I'm allotted. Again, Seren Taylor, Vice President of the Personal Insurance Federation. We are a statewide trade association. These are our key member companies. I'm going to move, hold on, I'm going to move this out of my way so I can see. But, you can see we have 11 of the largest insurance companies in the state. Those companies alone represent almost 76% of the homeowners insurance market. And with that, I'm going to run through some of these key issues, from catastrophic losses to the inflation the commissioner was talking about, the need for the rate reform and the outdated regulations, and the FAIR plan. I'm going to move quick, and so forgive me, but you can always stop me and ask questions as need be. So one, talking about the losses just since 2017, California home to 8 of the 10 costliest wildfire losses in the history of the planet. And 9 out of 10 occurred since 2017, 8 out of 10 in California. And you can see, obviously, the Camp Fire, the Tubbs Fire that are famous. And then number 8 was, you guys unfortunately had to experience the CZU fire back in 2020. But that's one of the key ingredients to this problem. Just the changing nature of peril and risk in the world, in California in particular, has changed a lot in a very, very short time. And we're all grappling with it. This chart right here, if I only had to do one chart, it would be this. And this really shows you the last 20, 30 years of what's happened in California. But if you start with 1991 all the way to 2016, it was pretty stable and predictable. Insurers, they lost a little money, made a little money. Our rates were or still remain low, but were very low. And things just kind of plodded along. There was the big tunnel fire in 1991, but that sort of was an outlier. And then it was pretty quiet all the way through to 2006. You see insurers then, their underwriting gains. This is what this chart is, by the way. This is insurer underwriting gains and losses. And it's just cumulative. So they were losing money. 2006, they start to gain. And by 2016, over 25 years, they were positive about $10 billion. And insurance is not a year-to-year business. It is a long-term business. You lose money, you make money. You just have to stay ahead of the curve over decades, not each year. But then what we see happen, 2017 and 2018, really those 2 years alone wiped out the past 25 years of gains and left insurers $13 billion in the hole. And as you can see, they're coming back from that. As of all the data that you're going to see lags about 2 years. That's just the nature of the data. Hopefully we'll have this updated in a couple of months for 2022. But there's still about $2-3 billion in the hole even today. So moving along, the other big contributor to this problem, inflation, and particularly the hyperinflation that occurred during COVID from 2020 to 2022. The cost of rebuilding a home between the materials and the labor went up almost 35% in just 2 years. So if you think about that, setting aside the wildfires completely, you would still see a massive increase in exposure for insurers just from inflation. And of course, it's the same thing that you're seeing in your home, right? When you go to the grocery store and eggs have gone from $4 to $8, and Campbell's soup, which my daughter loved, went from $2 a can to, no, I'm sorry, 2 cans for $1 to $2 for 1 can. That affects insurers as well. The cost of lumber, the cost of materials, all of that. So absent the wildfires, rates would still be going up dramatically just because of inflation. And it's not something that anyone controls, but that's a reality that we all have to accept. So looking at another reality as to what's happened in the insurance market, I got tired of debating this with the consumer groups that were saying the insurers are doing great, they're making plenty of money. So I said, let's use the Department of Insurance's own slide. This is from the Department of Insurance website. And it talks about over the past 10 years, homeowners insurance companies have done far worse in California than nationally. Countrywide, there was a 4.2% direct profit. In California, minus 6.1%. The underwriting profit, which was the chart we just talked about, countrywide, positive 3.6%. In California, minus 13.1%. Insurers are not doing well in California, and things need to change. And we're going to get to what the commissioner is doing to address that. And again, getting at the average premiums. And again, agreeing with the commissioner's remark, it doesn't make anyone ever feel better when I tell them that California actually has among the lower premiums in the nation. And when you look at actually income in California and the cost of housing in California, we have the second lowest in premiums in the nation, only behind Hawaii. So while it may not feel like it, and it also varies by where you live, California insurance premiums are a very low deal relative to the rest of the nation, and particularly relative to other climate change adjusted states like Florida, Louisiana, Texas, Colorado, etc. Again, I know it's not going to make you feel better, but it is a fact. Moving over to these key issues really of CAT modeling and reinsurance that the commissioner touched upon. You can see, and this is not a ding at the Department of Insurance, but you can see a rate filing at the department. It is taking about a year, right? So when you think about that, when you're in an inflationary period where costs are going up and exposure is going up 15% in a year, and it's taking you over a year just to get a rate filing approved, you're actually falling further and further behind as you're trying to catch up on your other losses. This doesn't work. The commissioner has some historic reforms to address it. And, it's not to put blame on anyone, because the department, these are very complex filings. They can be 1,000 pages long. The department, much like other businesses, suffered historic COVID retirements. It's not easy to find actuaries who want to go work at the Department of Insurance. And so there's reasons behind this. But again, it just contributes to the problem. And the commissioner has some reforms to address that as well. Getting at the catastrophe models. Here again, the current system says insurers have to look backwards, 20 years historical losses. Well, what happened, if you saw at that first chart, what happened 20 years ago, prior to 2017-18, reflected nothing as to what was been coming. And so for insurers who haven't suffered losses in high-risk areas, they can't get an actuarially fair price because they have to experience a loss before they can price the risk. So they're not going to move into those areas. No one's going to go lose $500 million just so they can get a rate increase. So the idea with these CAP models is that they will allow insurers to be able to project losses and risk in high risk areas where they haven't suffered a historical loss, but that there's whatever it is, when there was 5 years of drought and 200 million dead and dying trees, or like we had this summer, 40 days in Sacramento of over 100-degree days. You see the toll on the environment, you know what you're getting into. California is the only state in the nation that doesn't allow the use of CAP models. Again, the sustainable insurance strategy is going to address that. Similarly, the net cost of reinsurance, California, the only state that doesn't allow that. The net cost of reinsurance is just reinsurance is insurance for insurers, how they spread the risk that they take on across the nation and the globe. It's like flour, eggs, and sugar for a baker, or labor and water and fertilizer for a farmer. It's just a cost of doing business. If you can't reflect that in your costs, then you're not going to be able to write more business, because the reinsurance allows you to take risk off your books, bring more capital to California, and increase your leverage ratio so that you can write more business. I'm just going to say State Farm is a perfect example. Over 4 years, they lost $4 billion of claim paying. Well, I'm sorry, they went from 4 billion to 1 billion in claims paying capacity. They had to freeze their business in California. If they could bring in the net cost of reinsurance, that would allow them to bring more capital back, take some risk off their books, and they could start writing again, right? So that's the power of reinsurance. But if you can't get that into your rates, then you can't afford to use it. So that's the short version on reinsurance. Now, what happens when we have this market dysfunction? The FAIR plan becomes the pressure relief valve. Again, some dated data here, but the FAIR plan's been growing. We all know this. This number here at the end, where it's at, this was at about 250,000. We're now pushing towards probably 400,000 people moving into the FAIR plan. Historically, it was around 150, even 125,000. At the same time, the FAIR plan's exposure has grown from $50 billion to over $400 billion of exposure. You can see in Lake Arrowhead, Crestline, Big Bear, that's where fires are burning right now. There's almost $30 billion of exposure in those areas right now where the FAIR plan is heavily concentrated. The FAIR plan doesn't have any money to pay for losses in these fires. They have about $200 million of claims paying capacity. When the FAIR plan can't pay its bills, the regular insurers, they get taxed with an assessment to go pay that. Now, if they can't recoup that, they're stuck losing that money, comes out of their claims paying capacity. They have to non-renew more people. This is a major concern. And again, it's very important that the commissioner is addressing that and creating financial stability there. But in the meantime, what's happened? If you're an insurer and your reward for growing your market share is that you have a higher share of the FAIR plan assessment, because the FAIR plan assessment is based on your market share. So if you grow, you take on a bigger chunk of $400 billion of exposure. So we've got to deal with the FAIR plan, and the Commissioner's Sustainable Insurance Strategy does do that. So that's another good step in the right direction. Again, just to make the point, you know, AM Best, a 100-year-old rating company, downgraded the entire segment from stable to negative. That's where the insurance market is in reality. So how do we restore a healthy competitive insurance market? First, mitigation is important. I know we're going to have a lot of talk about mitigation. I'm just going to say up front, mitigation is important. It's not prevention. Mitigation is not prevention. When you get a fire conflagration that's burning and it's got 40-mile, 50-mile-an-hour winds, there's virtually no amount of mitigation that's going to stop that. And if you ever visit the Camp Fire site, Paradise, or even the Tubbs Fire in Sonoma, the fire chief there will point to a concrete building with a metal roof that just got so hot, it exploded. That's what happens, right? I saw in Coffee Park in Sonoma, just the metal rims from cars melted into the ground. You have fire tornadoes, their own weather systems. There's no amount of attic screens and defensible space that is going to stop that. But mitigation is crucial. That's a big part of what we all need to do. We need to reduce risk and loss to bend the curve over time and really bring stability to the market and help eventually to bring rates down. Hopefully that's the goal. And what are some of those mitigations? You know, this is IBHS is a research facility that insurers depend on heavily. They have something called the Wildfire Prepared Home that goes through the basic things you should do, and then the Wildfire Prepared Home Plus. Insurers really respect their opinions. Their mitigation recommendations are built into the commissioner's regulations on wildfire risk models and rating plans, and insurers have to recognize and give discounts for those things. Everything from ember-resistant vents to 6-inch vertical clearance off the base to the 0 to 5 foot ember-resistant zone, fire-rated roof, meeting Chapter 70 building requirements. That's all in there. And then lastly, the California's Sustainable Insurance Strategy, right? This is what the commissioner was talking about. Here is a historic agreement, and I'm going to say insurers don't love this because in other states, every other state, insurers get to use catastrophe models. They get to use the net cost of reinsurance. Normally, a rate filing takes about 50 days or less to get approved. And in California, they're getting told, if you want to use these tools, you have to commit to writing no less than 85% of your statewide market share in these identified distressed areas. So I'll end there and and just say thank you, and I'm sure we'll have more in the discussion portion. Thanks.
Yeah, that was really great. I wish we had more time for you, but thanks for that. Thanks for keeping on schedule. And we'll be back with the Q&A. We've got a number of questions that are have you as a targeted responder.
The fly in the milk. I'm used to it.
Okay.
Okay.
Next on the agenda is California Assemblymember Gail Pellerin from our 28th district. And I think from my notes, you have 10 minutes. And
Oh, I probably don't even need that long. I feel like a lot's been said, but thank you.
okay. And I think I heard you don't have slides. Is that correct?
I do not have slides, yeah.
Okay. Well, we're looking forward to what you have to tell us.
Okay. Well, I mean, certainly, well, I'm here, and as well as my field representative, Lizette Jones, who staffs the Santa Cruz district office. And this is really one of the most frequent phone calls we get in our office from constituents reporting spikes in their insurance costs or cancellations. And then many of you also have never even filed a claim, and after having invested, tons of money in home hardening. And I can totally understand the frustration with doing the right thing and then get penalized for it. So you do all the home hardening and then you still see insurance rates go up, or you get a cancellation in your coverage. So, I'm very grateful that all of you are here tonight. We've got 145 participants, and I put our district office phone number in the chat. So please reach out if you have any questions, comments, issues. It's heartbreaking, and it's just infuriating dealing with this crisis. At the state level, we put together a working group this last year to address the insurance crisis in California. And as Commissioner Lara says, it's really reaching out beyond just the home insurance costs, but we'll focus on that for tonight. And and so we put together ideas and thoughts and plans to try to deal with this crisis, and brought the insurance commissioner Lara in, and he's like, I think I could do a lot of this without legislation. So we said, okay, let's do it. And I'm hopeful to see what we have in place by January of this next year to address these major concerns. And as folks said, that, we're in this situation because of the unprecedented wildfires. You saw that in the PowerPoint slides, our changing storm patterns, the increased risks of flooding, especially our San Lorenzo Valley, the Bonny Doon area. You really took a beating in this last, couple of years of the atmospheric river after atmospheric river. And we were doing everything in our power to restore your power, to make sure you have your PG&E rates, power back on, and opening the roads up again. But the frustrating thing is then you turn around and you open your mail and you get that non-renewal notice that is just earth-shattering for you. And the other frustrating thing that we're hearing as well from insurance carriers is that it was taking 1 to 2 years for the insurance providers to get an answer on their rate increase. And so, as the commissioner said, they're working to reduce that amount of time, because there's no way for a business to sustain if it takes that long to get an approval of a rate increase. And the reality is, the slide showed that that California is still paying less in home insurance rates than other states, because the cost of rebuilding is so incredibly high. And, in that campfire case with Paradise that went up in flames, there was an insurance carrier that had a lot of liability and had a lot of coverage in the Paradise file, the Merced Insurance Company, and they went bankrupt after that fire because they just could not pay out all those claims. And, the FAIR plan is the the safety net. That is the one place people can go to get insurance when they can't get it from any of the traditional carriers. And that's where our office can be extremely helpful, because we have contact information of people working with the FAIR Plan. You know, we were talking to somebody trying to buy a home, and they could not get an answer on getting the insurance to the FAIR Plan, and they were going to lose out on buying their dream home. So we were able to get on the phone, get the FAIR Plan folks to respond to them, and got them that much needed insurance coverage so they can move ahead with their home purchase. So we completely understand how this is impacting our community, and we are here to make calls. And as been said by the insurance commissioner and the last speaker here, is that we are putting pressure on those decision makers. We're demanding answers. We are extremely concerned about the FAIR Plan, because I feel like we're one big disaster away from it imploding and people just losing everything. So it's pretty dire. And, you know, we're starting to see some rate increases being approved. Allstate was approved with a 34% rate increase, and that was the highest rate increase we've had in a number of years. And so I'm hoping they will be back in the market writing policies. We're hoping to get the other insurance companies to follow suit as well. But, you know, my understanding is that State Farm is still not issuing new policies in California. I believe Farmers is still doing some here and there as well. So, you know, I'm hopeful. My colleagues and I, we're committed to ensuring that Californians have the insurance coverage that we all desperately need. And we're working toward long-term solutions for a resilience and bringing back a fair and equitable market where people can get that critical insurance you need for your home. So we're here as a resource. We're here as your advocate. We are part of this community, and we have had the same things happening to us. And it's really frustrating. I know when I got a non-renewal, I submitted a complaint to the insurance commissioner's office, and I think it's good to document those non-renewals, especially when you're in an area that you have done home hardening and you may have a very low fire score, and so that needs to be reported. And I got lucky in the one case. I got the insurance renewed after that complaint was filed. So it does help, but and we're here to help, and we can't negotiate FAIR Plan rates for you. And I know it's extremely expensive, but we can help you get a response and be able to get coverage for your home. So that's where we are. And we'll be sticking around here tonight to answer any questions you have.
Thank you, Gail Pellerin. And we do have some questions, I know, coming up in the Q&A that are targeting your expertise.
Thank you. We'll be ready.
Okay. Our next speaker is Dave Reid from Santa Cruz County Office of Response, Recovery, and Resilience. Dave, do you have a presentation to share? Actually, I don't even see you yet.
Okay.
I think I'm on, or at least.
Okay. Yeah, I think yes.
Yeah, I'll share a couple slides and then just share a couple resources and try and be brief so that we can continue on with the speakers and get to questions.
I think you had 10 minutes allocated. Is that right?
Yeah, I can be. I'll shorten up just given the breadth of what we've discussed already. But I wanted to share a little bit to start some data that drives much of what we already have heard home in terms of some of the statistics. We, in our office, worked with our county folks to map some of the non-renewal data statewide and then locally. So I wanted to share that data with the group to show and demonstrate kind of how things have changed over time and then how we're being impacted. So this is the percentage of non-renewal statewide. And I'm just going to step back in time. You can see Santa Cruz here in the medium orange level in 2021. Again, as was mentioned, the data lags. So this is the most current. And then as you step back in time with this data, you can start to see we are consistently one of, if not the higher range of non-renewals in the greater Bay Area, oftentimes mirroring Monterey County. But it's a significant impact on our community. And more local data, this is the same data, but brought into the kind of the zip code level and kind of zoomed in on the Bonny Doon area. On average, about 11 non-renewals per 100 residents in the Bonny Doon area. You can see other parts of our county are upwards of 38 to 46 per 100 non-renewals, all the way up to our Summit area in Santa Cruz and Santa Clara County at 66% of the policies in a non-renewal status. So it's certainly impacting folks countywide, certainly in Bonny Doon, and it's a concern that all the speakers have echoed. So I don't want to belabor that point, but I do want to share briefly a couple resources that are out there and things that we're doing in our office to try and support community. So there are two resources I put in the chat that I want to remind folks of. One of them, the first one that I put in, is the Recover California Homebuyer Assistance Program. That is a potentially transformative option managed through the Housing and Community Development Division of the state. And it's to offer up to $350,000 to folks that lived in high fire severity zones in 2020. So you did not have to live in the CZU burn scar. Anywhere in the county, you're eligible for a forgivable loan of up to $350,000 to help purchase a home outside of a high fire severity zone. So what we know happened in the CZU fires that a lot of renters in Bonny Doon, in the San Lorenzo Valley, were impacted and displaced, lost their home, and did not have nearly the resources that many homeowners did, even though those resources, as we've heard tonight, were inadequate for the cost of rebuilding. So if you don't own property right now, if you are a renter in Bonny Doon or were a renter in the county in 2020 in a high fire severity zone, you may be eligible. So I want folks to check that out. The other piece of resources, the second link I put in there is a link to our long-term recovery group, but it's a page to the owner-occupied mitigation grant program. And they're actually modifying that grant program as we speak to increase the amount of money that you're eligible for to $75,000, and your income level is going to go up as well. So folks that make a little bit more money will be eligible for that. And that money can be used to do some of the things that were just spoken about around mitigation, home hardening, defensible space work. So that is free money. If you're income qualified, if you're a low income senior in particular, it is a challenging application process, but we really do want to encourage folks to take a look at that program to bring some extra dollars to build some resilience to your home. The last thing I'll say right now is, and to keep folks moving in the conversation is our office is working closely with the Resource Conservation District, the Fire Safe Council, our local Bonny Doon Fire Safe Council, all of the Firewise communities that are building up in our county. We have the most or second most Firewise communities in our county and state. And what we're trying to do at OR3 is to try and build capacity within all of our organizations so that we can go after grant dollars to bring work to the community level. So stay tuned. There's some exciting grant opportunities that are going to be coming online. And so we want to try and bring additional resources to do hazardous fuel reduction work, home hardening, defensible space. Because while it is true that certain fire conditions, it's very hard to survive those fire conditions, landscape scale fuel reduction work, hazardous fuel reduction work around your home, defensible space work reduces the fire intensity. And that does give you a fighting chance if you do those things like the zone zero, like the home hardening, like all of those things if we can do the larger scale fuel reduction work in the Bonny Doon community and around the county, we're hoping that the wildfire intensity will diminish. And I will close with one last thing. For those of you who are not signed up for CruiseAware, CruiseAware is our alert and warning platform that we use to communicate with you during disaster, but also during blue skies. And we have added a functionality to CruiseAware, which allows you to sign up for prescribed burn notifications. So as we transition from what I call bad fire season to good fire season, there will start to be prescribed burns in and around the Bonny Doon community. And anytime we see smoke in California, and certainly in our community, it's stressful and it's traumatic. And being able to get a little bit of information about where that fire is coming from and why may give you some peace of mind. So we encourage you to check out the CruiseAware prescribed burn notification tab. You can check that box on the prescribed burn notifications, and we'll be sending out emails when we have information from our state parks and CAL FIRE partners about prescribed burns that are scheduled. I'll stop there and cede the rest of my time to the next speaker, Dave.
Okay, thanks, Dave. And I think there are a couple questions that you can help out with if we have time to get to them. The next speaker is Joel Laucher of United Policyholders, and I believe you were allocated 15 minutes. I'll set the timer. Do you have a presentation to show?
I do.
I think you should be authorized to share if you hit the share button, the green button at the bottom of the screen.
Thank you.
And after you click on the share button, it'll ask which app you want to share, or if you want to share your whole screen.
I hopefully I'm sharing my screen right now.
No, I don't see it.
Okay.
And I see Assemblymember Pellerin shaking her head no.
Okay.
Yeah, Joel, you'll see it'll show all your documents, and then you click on the document you want, and then you hit share.
Yeah, this has seemed to have dropped me from the whole Zoom event. Can you still hear me?
Yeah.
Yes.
And see me, I guess?
Yep. Just
Okay.
we don't see your shared screen.
Yeah.
Okay.
Look on the bottom for your Zoom icon. If you click on that, you'll come back to the main Zoom screen.
Yeah, I'm back in the main Zoom screen, and now I'm clicking the share again.
All right. So when you do that, you'll see all different do you have your document open that you want to share?
I do.
All right. So just click on that and then press the blue share button.
Okay, you
How's
got
that?
it.
We're looking good.
Oh, man, okay.
Well, it says it's starting.
Okay, so, all right. Hello, everyone. I am from United Policyholders, which
Joel,
is
you need to click again to get full screen mode, right? Or is everyone else seeing it?
Yeah,
No.
no, all it says is it's just that he started screen sharing. We're not seeing your slides.
no.
So you have to
Okay.
double click on it, I think, to enter full screen mode.
It says stop. Okay, let me try again here.
There we
There you
Now
go.
now we can
Okay.
see it.
All right. So again, I'm from United Policyholders. It's a nonprofit. We work helping people with insurance issues. Formerly, I worked with the Department of Insurance for about 35 years, where along the way, I was head of market conduct, deputy commissioner rate regulation, and chief deputy commissioner. But since then, I've joined United Policyholders. I've worked actually a couple disaster and local assistance centers in Santa Cruz Library after floods and CZU fire in the centers that were held out in the Felton Library and Boulder Creek for a number of weeks. And so I'm hopeful we can be helpful here as well. So let me do my next slide. So that's United Policyholders. Just an idea of the premium increases that are already occurring. Was mentioned State Farm got a 20% overall rate increase. Of course, when a 20% rate increase is on average, it plays out differently in every zip code and for every home. For Bonny Doon, the average of that 20% rate increase was an average of 21.9%. So a little higher than the overall increase State Farm put in place. But even that Bonny Doon 21.9 is also an average, meaning some people in Bonny Doon might have gotten a 15% increase, some might have gotten 25. And that seems like a lot. Just to make you maybe feel a little better about your position, look at Big Sur on this slide. They got an average of 48.7%. So pretty rough. And on top of that, we know State Farm has filed another 29.4% increase. Allstate just got approval of a 30% rate increase. So this is under the current regs without any of the Sustainable Insurance Initiative the commissioner is talking about. These are just rolling forward increases that are going to be, again, potentially another 30% for most State Farm homeowners on top of a 20 they just received. So overall, on average, 55%. So it's, pretty rough how this plays out. Just an idea of how insurance rates work. Maybe a little over a decade ago, insurers started putting out scoring models that evaluated things such as the slope, the fuel, and the access of any given home relative to other homes. This representation is actually a satellite image of Bonny Doon from Google, and the two circles kind of represent two different homes in Bonny Doon, not very far apart, and actually just above Beauregard Vineyards there on Bonny Doon Road. And in years past, these two homes would have received the exact same rate because they have the same protection class. If they're both wood frame dwellings of about the same age, they have the same territory because they're in the same zip code. But even about 20 years ago, these started to change because insurers started to be able to differentiate based on slope and fuel and access of the property. So the one up above to the right might be a little higher up the slope, might say doesn't have a little less access, might be closer to more fuel. So even a home a couple hundred yards apart would start to pay a lot higher premium. That was the first iteration. The next round actually was to move to aerial imagery. So just so people understand, we are getting a much more granular look at the home. This is what the industry is seeing through its modelers that are doing scoring of homes. So now you're not way up there with that satellite view and just making kind of these broad stroke judgments. In this case, this home might have scored well in the previous model, but now the insurer is going to see that it has tree limbs that grow out over the roof line of the home. And the data points that roll into the models include things such as the year built of the home and that will tell the insurer the building codes in place at the time the home was built. Therefore, they'll know the type of vents that were in place when the home was built. So they'll know if it has ember resistant vents, as an example, as opposed to, for example, in my 1960s built home, very wide wire mesh vent covers. And it's one of the reasons you really need to tell your insurer if you make any changes to your home, upgrades, such as replacing your vents, your old vents with ember resistant vents, or replacing that mesh over the vents, because otherwise they base on the assumption from their database of the year built of the home. And ember resistant vents, for one example, get you a discount with every admitted insurer in California. But you get a sense here of how much an insurer is making decisions about your home without really needing to even drive by or talk to you. So, fortunately for some, at least, the department has put in place a few years ago mandatory discounts that insurers have to give for each and every one of these items. That's from the state's Safer from Wildfire checklist. So any one of these you do gets you a discount, even if you don't do the rest. Works a little differently in the FAIR plan, where you have to do either all the building hardening measures or the property level ones to get the grouping of discounts that are laid out there. But they are for these same actions. Seren mentioned the IBHS wildfire prepared home. These actions are very similar, couple differences here and there, but these are the ones that are mandated for discounts. So we're talking here to a lot of people that have probably been afraid of non-renewals or received a non-renewal notice. And so what we really want to do is give you the best advice we can. It's a really challenging market. So, if you just don't go out there and find an insurer right away, don't blame yourself. It's, a lot of people are ending up in the FAIR plan, but it doesn't mean that you shouldn't try to find coverage. Contact any, of your available local agents that are there to help you. I know we have a couple sitting in tonight. I did a presentation with Mr. Cassidy, one of the members here, it may be very tough for agents to find coverage, but you want to try and you want to start right away. You get 75 days, but you may have to reach out to agents or insurers that you've never heard of. So keep track of all the ones that you have contacted. So common reasons for non-renewal for many people currently, it is wildfire risk, or maybe some of the others here that are common. If you've had a loss in the last few years, the age of your home, but a lot of it is about details about your home, the age of the roof, or if you have a wood shake roof, those are almost not accepted by any insurer currently. Galvanized pipes are still an issue. Knob and tube wiring, common in older, more like Victorian homes. Even people in San Francisco are having issues keeping their coverage despite not having, let's say, a green belt exposure if they have knob and tube wiring. If you have a pool or a trampoline, those are issues. And one you can't do anything about is the value of your home. Insurers are trying to reduce their concentrations of values in any given area. I do have to say, for many decades, insurers sought to consolidate and buy each other out and gain more market share. And unfortunately, now that they've changed their mind, maybe driven by climate risk about how much concentration they want to have, there aren't as many insurers. and in large part because, you know, they kind of gobbled each other up in the 70s and 80s. But, you know, you face the world you're in, and you're going to want to contact as many of the insurers that are writing as you possibly can. So, you know your rights. So you're an insurer that sends you a non-renewal notice has to tell you the specific reasons for that non-renewal. They have to be objective, risk-related, and applied consistently across their book of business. So, you know, you want to understand what it was and that it is fair and consistent with your home's conditions. You want to make an appeal to the insurer if they have something wrong. And if they don't recognize that you are correct in your appeal, you should contact the Department of Insurance. But you do want to get shopping otherwise. If the rationale is sound and logical and risk related, you need to get shopping. So we have information at uphelp.org, California Insurance Help, to help you get, you know, find ways to shop the whole marketplace. You know, you're not just going to be able to rely on those 3 or 4 insurers you may have heard of in the past. There are dozens of insurers that write homeowners coverage in California. I'll mention another tool available through the Department of Insurance is there's a page here under residential insurance, pointing out a couple of the most useful pieces here. There's a home insurance finder that you can put in your address. And there's also a top 10 tips that give you 10 ways to kind of look for coverage. One of those ways is the 800 number for every admitted insurer that does business in California. A lot of them you may have never heard of, American Modern Mutual or Tokyo Marine. It's likely to be a wild goose chase to call some of these, but before you end up in the FAIR plan, you may want to try every one of them just to give it a shot. You know, it's going to take a lot of patience to deal with it and deal with a lot of rejection potentially. But, you know, if you are rewarded by finding something, that's awesome, of course. So, you know, give it a try, at least to your tolerance level. One thing we recommend now when rates wherever you have coverage are going up is to do as much mitigation as you can. At least those are discounts you're going to get by mandate in California. Ask your agent about whatever discounts the insurer you're with does offer other than the mitigation ones. Maybe there's something else you can do. Raise your deductible. If you've been with the same insurer for 20 years, maybe when you placed your deductible, $500 seemed like a lot for a deductible. That's not the reality, hopefully, in your life anymore. Hopefully you can afford a $5,000 or even a $10,000 loss without having to file a claim. If so, then increase your deductible as high as you can, reasonably afford to accept the loss so that you will get a discount for that high deductible. And just a couple more things for you to know, because I'm running out of time. You should ask your agent about whether the company that is offering you a quote, if you get one, are they admitted or not? If they're admitted, they're backed by a guarantee fund. If they're non-admitted, meaning or surplus lines, meaning their rates aren't regulated by the Department of Insurance, you really need to check their financial rating. You probably want at least a B+, if not an A, because if they go insolvent, there is no backstop for surplus lines carriers, just to know. The FAIR plan is an option, unfortunately, a lot of people may find as their only option. And the FAIR plan is backed by an assessment on other carriers, so it does have financial strength. But a FAIR plan, just so you know, that policy is bare bones. You do have to augment it as best you can and add a companion coverage I'll mention in a second. Force-placed and lender-placed coverage sometimes comes up. That's just securing your loan. That really won't help you if you have a loss. So just to be aware, the FAIR Plan, basic property insurance, you want to add a difference in conditions policy to get coverage such as water damage, which is one of the most common causes of loss that homes have, or liability losses, meaning like a trip and fall. They're a very unlikely loss, very few of them, but they can be very costly if somebody falls and is injured on your property. You will wish you had liability coverage. So again, FAIR Plan plus a difference in conditions policy equals comprehensive coverage, somewhat like a homeowner's policy. I see I'm out of time, so I'll just mention a couple more things. Try to avoid being underinsured, despite how much insurance costs. You know, I unfortunately, in my career at the department and in this job at United Policyholders, I meet with a lot of people who have lost their home, and not one of them ever expected to be in this position. And that everyone that is in this position is very grateful for the amount of coverage they have. But in almost maybe 80% of the cases, they really wish they had enough to rebuild their home. And despite some of the information you might get in your insurance packet that shows, oh, you're fully insured, you may find you're very short of full coverage to rebuild your home. So try and get a real estimate of the cost to rebuild a home in your community, and kind of use that as a gauge, and at least get to within the range of reasonable of that limit. You know, maybe you don't want to spend all that money, but at least get to a reasonable number. And one last thing, inventory your personal property. This just means walk through your home with your phone and video everything in your cabinets, your drawers, your closets. If you do have a major loss, your insurer can make you list every item that you own that you want to claim, when you bought it, what condition it's in, what you paid for it, and pay you item by item, the depreciated value and only the replacement value when you buy it. If you have this information on your phone, at least you have evidence that you owned all this information. So owned all this property. So at least have a record showing, you know, you're not making these things up. You're not filing a false claim, that these were your things. And a video, simple way to show that. And just one, I keep saying one last thing, I apologize. But I got to say, an expectation everybody should have from the department's sustainable insurance strategy is premiums are going to go up significantly. I just mentioned State Farm and Allstate are already getting big increases. When catastrophe model results flow into rates and reinsurance costs flow into rates, it is going to be another major bump up. So just, there's probably no control over this, but you should just be aware this isn't going to resolve the affordability issue. It's meant to hopefully address some of the availability issue, but to some degree, it may exacerbate the affordability issue. So please take our home survey at uphelp.org, UPHelp, our California Home Survey. We have information on help you find resources to deal with insurance and do mitigation. There's also resources through the state, Listos, California.org. And again, thanks for having us from United Policyholders, and my apologies for going over time.
No, thanks. That was worth a couple extra minutes, at least, maybe. Thanks for your presentation. Thanks for the information. I know there are questions that had targeted your expertise, and some of them you answered. So that'll give us a head start when we get to the Q&A session. We have one, before the Q&A, we have one last presentation from Edan, Cassidy, and Jessica Murawsky Cassidy Insurance Agency. And I forget how much time did Eric assign you?
Think
We're
we have-
not sure. It was either 5 minutes apiece or 5 minutes total, but we'll make it work.
We'll make it
Okay.
quick.
Okay, I'll start this. I don't know which it is. I'll start you at 7 minutes in between.
Okay. Thank you
Do you have a
for,
presentation to show?
no, we don't. No,
Okay.
it's just the two of us talking, and as much as you can put up with that, maybe we'll give some useful information. Thanks to the Rural Bonny Doon Association for inviting us to participate. I didn't plan to say this, but I'm very pleasantly surprised by Commissioner Lara's comments tonight. And I hope it's not an insult to say that that is a 180-degree pivot from the department's position just 18 months ago. So I feel like we're headed in the right direction with their support now, and we didn't always feel that way. The idea that this will be across the finish line in December, that carriers will submit rate filing requests January 1st, and that the solution is just around the corner, no way. It's way off in the future. That doesn't change the current state of affairs, which is the homeowners insurance market in Santa Cruz County in the state of California, especially in Bonny Doon, is bleak. I don't know how many people have the history and understanding of Prop 103, but Prop 103 gave California consumers powerful control over insurance prices for over 30 years. But it was not designed to evolve with climate change and periods of runaway inflation, let alone a pandemic. So the benefits of the 3 decades of extreme rate regulation in California appear to have run their course. When insurers are not able to price to the risk, they tighten the rules and they stop writing altogether. In addition to the non-renewals that we're all familiar with, all major insurance carriers have been approved for or await major rate increases. There are no longer any $1,200 homeowners policies in California, and there never will be again. The average cost to insure a modern home is now 2.5 to 3.5 times what it was just 5 years ago and up. It's analogous to paying another property tax bill. No major insurers are completely open to write classic homeowners in Bonny Doon or the surrounding areas. Companies with captive, dedicated agents like State Farm, Farmers, Allstate, etc., are closed to new policies for homeowners and actively proceeding with thousands of non-renewals throughout large portions of Santa Cruz County. Just to give you an idea, State Farm is non-renewing 30,000 homeowners policies in California. 15% of those are in Santa Cruz County. That's 4,500 State Farm non-renewals. So you might imagine the flow of business that we and other brokers are dealing with. Direct writers like USAA and Geico, they're in the same boat. Non-reneweds include many centered in tracts in Scotts Valley and Santa Cruz, which were previously easy ground to insure. That lack of markets means that almost everything now finds its ways to independent agencies that write with many carriers like we and other independents do. And the last time that I checked, Cassidy Insurance Agency is the only one of those left in northern Santa Cruz County. Much like Joel described the aggregating and acquisition of insurance companies, independent insurance agencies have been gobbled up and become part of corporate parents. And so they don't exist in the way that they did just 10 years ago. As a retailer, we have fiduciary duty to our customers. We do not advocate giving insurance companies the freedom to carte blanche, charge whatever they want without regulation, but we do advocate anything that can be done in the short term to speed the path to overdue rate increases, which will allow insurers to achieve what they term rate adequacy, and will bring products and competition back into this market. We need all of the major carriers to return to active participation in this market, not just their share of the FAIR Plan. Why are carriers not writing besides price? Each insurance company uses proximity to hazards, as we've heard throughout tonight. And there is no part of Bonny Doon that is off limits from those hazards to most standard or preferred carriers. For this reason, homeowners should pursue mitigation. You're unable to control everything within a mile of you, let alone your next door neighbor's defensible space. Besides the defensible space and wildfire mitigation, we are commonly asked, what can we do? Should we contact and start the process with multiple agents or brokers? How do you know which agents or brokers are the correct ones to contact? Our recommendation, and it's not just for ourselves, is to use one independent agency or broker. Independent agents don't work for an insurance company. We have fiduciary responsibility to the consumer, and you should find one that has numerous markets, is ethical, has your best interests at heart, understands your community and your risk, and work with them. Once you've done this, continuing to shop around at that point does not always serve its intended purpose and may impair or block your access to certain markets. Rates every agent obtains from every one of these insurance company markets, including the FAIR Plan, are exactly the same and vary only with the coverage limits that are chosen, the deductibles that's chosen, and whatever inaccurate data the agent or broker submits to the company. In addition, the contracts that all of us agents have with each of these insurers determine how conflicts between agents are resolved. Some other agents or brokers will end up blocking our access to a market with a submission that they abandon. And very often, inaccurate submissions fall apart once the property is inspected. So do your diligence, choose one agent or broker that has a lot of markets and knows your situation, and go with them unless you feel like they don't know what they're doing. We assembled a packet of resources for homeowners that we provided to the RBDA that is available to all attendees who want access to it, who just request it. And hopefully now there's time for my colleague Jessica to provide another perspective on what we are facing as a community.
Thank you. I'll be quick. My name is Jessica, and I am an insurance broker. And I, like Edan said, was a little surprised with what we learned tonight. So I had a little something different prepared to speak about, but I'll go ahead and kind of talk about what we're dealing with at our agency. And to add to Edan's point, I just wanted to mention the importance of working with somebody that you trust and finding an agent that is honest and ethical and will put in the time and the effort to help you find the best options, even though we know that the options right now are very limited. I also wanted to just mention that I am working for you as the consumer. My family and I have been in northern Santa Cruz County all my life. And I love this community and the friends that I've made. And not a day goes by as of late that I'm hearing stories from my community members that are filled with fear and anxiety and stress and having to deal with this insurance crisis and receiving that dreaded non-renewal notice. I hear daily from clients things like, I've been with State Farm or Nationwide for 40 years. I've never filed a claim. I live across the street from the fire department. I have defensible space. What can be done? So we hear you, we understand. I've had customers calling in tears, asking how they can pay for their insurance on a fixed income. They have mortgages, they're worried they can't pay for their insurance. My manager, Cammie, Katie, Edan, myself, and our entire team have been working 12-plus-hour days due to this influx of business that's coming our way. I'm a mom. I have a senior at high school, and she's becoming very used to seeing me come home at 9 p.m. every night because I'm working so hard trying to get people policies. We want this resolution just as much as you do. And having said all this, I just wanted to reiterate what Edan said, that the importance of working with a knowledgeable independent agent will make a difference in these hard times. We have the ability to work with you on your coverage options, increasing deductibles, knowing what discounts are available to you, what to expect during an inspection. These are all examples of how we can work together to make things a little bit more comfortable, even with the California Fair Plan. So finding a broker who works with multiple markets, has your best interests at heart, stick with them to find your best solution. And I can speak for myself and our team at Cassidy that we will be in touch with you. We will be able to provide you coverage. It doesn't benefit you to shop around at a time like this with numerous agents. And I just hope that, you know, the insight that we learned tonight really happens and things that improve for all of us. So thank you for your time.
Thank you, Edan and Jessica. Okay, we had hoped to wind up this meeting by 9:30. That only leaves 20 minutes for a Q&A. I don't know what the other participants' schedule is. I'm happy to hang around and hear a Q&A going on longer if the panelists are available. With that said, let's start in with the questions. So I mentioned we had more than 40 questions submitted by our community, Bonny Doon, and adjacent communities that had this meeting information distributed to. We took these questions and largely our corresponding secretary, Laura Lancaster, consolidated them. We still have a lot. Some of them were just answered. I'm going to try and go through fast, and hopefully there are a lot of questions. A lot of answers can be provided by all of you. So let's just try and focus on questions that have an answer. Some of these could probably go on for a half an hour for one question. But anyhow, let's get going. Two related questions about the near future concerns people have. And these were most likely addressed to Commissioner Lara. I think he's being replaced by Julia Juarez. Are you? I see you're there. Are you? Can you? Let's see. I'm making you a co-host. If you can put on your video, and then we can bring you onto the screen.
Apparently the host needs to allow me to open my video, and I'm not, there I am.
Yes, okay, and I'm going to bring you onto the screen. Okay, welcome. So this is a multi-part question. Oh, and also Assemblymember Pellerin, you might be able to help out with this one too. The two related questions. I procured the FAIR plan this year. What should I expect for next year? Will the FAIR plan simply renew me at the same high cost, or should I expect a private insurance company to take me on? Second related question. I've been told my homeowner's policy with State Farm will non-renew in May. What insurance options do you expect I will have by then? When do you suggest that I start contacting other insurance providers? If you don't know, because if you don't have a crystal ball, that's okay, and we'll move on. But what do you know about that?
If you are with a FAIR plan now, and you know, you can certainly stay there for and you know, be renewed with the FAIR plan. However, I would suggest that, I'm sure Joel, you would, I believe you will agree, that the best thing to do is really to continue looking. Continue shopping for insurance, because you will always, if there is another agency that might be able to give you insurance, most likely it will be on a much lower rate than the FAIR plan will actually be for you. So I would suggest that you continue to do that. Joel did mention all the the resources that you have at the Department of Insurance. We're at insurance.ca.gov is our website, but we also have our experts that are on the line that are available 9 a.m. to 5 p.m. every day, and who can help you navigate if you need help with that as well. You know, the expectation for us is to be done with our sustainable insurance strategy. And, you know, by the end of the year, by December 2024, we are expecting then at that point to be ready. We have been hiring our actuaries. We have, 12 new actuaries actually that have come on board. We have our all the different steps getting ready for for this, so that by January 1st, come January 1st, the Department of Insurance will be ready to get the new all the rate filings from the insurance companies. And we have heard from several that have said that they are going to be they are going to be writing right away. So we will see, by that point, we're looking at maybe mid-year for us to be able to see movement by then. And so I encourage you to keep looking, to continue to shop, and hopefully you'll be able to find the appropriate insurance for you that you will be able to use at that point.
Okay, thank you. The next batches of questions have to do with home hardening and wildfire mitigation. The first couple parts of it, I think, would be directed to Julia, because they ask, is the commissioner taking steps to require that insurers recognize home hardening efforts in their underwriting practices? And how can the state incentivize insurers to incorporate these factors? And one kind of change asks about specifically areas that burned recently often have reduced fuel loads and could be considered lower risk for future fires in the near term, at least. Is the commissioner taking steps so that insurance models more accurately reflect the reduced risk in these regions?
Yeah, so that is the expectation with being able to use the catastrophic modeling, is that they will be able to be more granular, so that they'll be able to see more, your home in a much better way. And so they will be then at that point able to then charge you the appropriate rate. So they will be able to see, is your home, when we're looking at the Safer from Wildfires framework, we were, very much so looking at very specific things that people can do, and you should be able to see that. We'll make sure to post it on the website on the chat as well. But with that, you have 6 things that you can do for your home, your actual home. Then 6 things that you can do for your surroundings, and then of course it's the community, the community involvement. Now, what this is going to do, the use of the CAT modeling will also allow you to not just the insurance companies to not just be able to see your home and directly and understand what you have done for mitigation, but at that point you will also be able to show what your community has done. Right now, there is nothing in place where insurance companies can actually see what your community has done. So if you have already, if you all have become a FireWise community, or your local city council or your local county has invested all this money in mitigation and just doing all of this work, there is no way for insurance companies to really know what it is that you have done. The expectation is that through the use of catastrophe modeling and also the data that they will be gathering from all of their consumers, they will be able to see where all of this mitigation is taking place, and then you will be able to actually get accurate rates. that is the expectation.
Okay, thank you. The next questions follow on that home hardening concept, but are more in the category of transparency. And so these are likely directed at Joel, Aaron, and Jessica. And the questions are, what do insurance companies consider when deciding which properties to drop? CAL FIRE hazard zone, details of the home structure, terrain and vegetation, distance from fire station, zip code, other factors. I think Joel mentioned that a little bit for rates and discounts, but this question was directed at non-renewals. And similar, following along that same line, is there anything I can do to my home to make it less likely to be non-renewed? Can I get guidance in advance so that I don't spend tens of thousands of dollars to try to retain my insurance only to then be non-renewed? Anyone want to take a crack at that?
I'll start, and I'm sure our agents would have something to say. I don't think that an individual can necessarily predict how an insurer is going to kind of evolve its book of business. I think in some areas, insurers have just decided, that they have an over concentration of number of homes or of in total values. Some of that just may be, a business decision. Some of it may be a reinsurer-driven decision, what coverage they're able to obtain and how much exposure they want. So the only thing that's really in your control is to do the things that you can, right? I mean, so you can't guess what they're necessarily going to do. But if you have a wood shake roof, you certainly have made your home more likely to be selected. If you have done the mitigations that are in that checklist, you have made your home less likely to be selected. Neither is a guarantee, though, of how the insurer will make its decision. I had mentioned that their obligation is to use objective, consistent, risk-related reasoning. So they do have to do that, but some of their decisions could be based on the last insureds they wrote that qualified are the first ones they're going to let go if they were to have to scale back in volume. Some could be choosing aspects of the home they don't like. There has been a resurgence of concern about that knob and tube wiring I mentioned. And there are homes actually in Santa Cruz itself that still do have that wiring in some of the older neighborhoods, Seabright and such, where you have Victorians. So, I mean, there are any number of risk factors that could be the basis for that decision. Each insurer is probably using some different, recipe for making the non-renewal decisions. But, a lot of them are the higher risk wildfire scores, obviously, that are their number one concern. And less is the urban business. So you can only do what you control in a wildfire risk community, right? Which is deal with your own home, encourage your neighbors to do the same, encourage your elected officials to try and get funding to do shaded fuel breaks and things that will actually have a more community-wide impact and stop the progress of a fire, because those are impactful. I think it'll be a little longer to get some of these wildfire models in place, maybe that Julio was mentioning, that do recognize all that mitigation in their projections. but that is one of the on the wish list of consumers is that models recognize community level mitigation actions that put at least some kind of barrier between that fire spread and where the homes are. Again, like a shaded fuel break is an example.
Okay.
I just add to that too. We put in the chat some information with a packet that talks more about the mitigation. And part of that question was, what if I've done all this mitigation and they still non-renew me? You don't necessarily have to go to an extreme, as Joel said, a shake roof, that might be something that you would want to consider. But there's some useful information in those packets of what they're looking for, the insurance companies, in regards to defensible space. And doing these things will benefit you even if you are non-renewed, because there's discounts that can be applied. And the other thing I wanted to mention is each new policy that we place, the carrier will do an inspection. And if you have a fair plan and a DIC, that means 2 carriers are coming out to inspect. They will report back to us if they have any sort of mitigation requirements that usually the insured has the opportunity to correct. So, it's preventative, but it's also not necessarily something that, if your home is in good condition and you have the defensible space, you don't necessarily have to go above and beyond that. And if there is a requirement like overhanging trees or something like that, the insurer will relay that so that you can make the correction.
And I'll add, one of the most common things is a roof that is over 20 years old. Yeah. Before you decide how to allocate your money in improving things, if you've got a roof that's 25 or 30 years old, I don't care if you bought a 50-year roof from the contractor, it doesn't matter. It's over 20 years old. It really narrows the insurance companies that we can reach out to with a solution.
Well, that's really interesting to me personally. My roof is 30 years old and I'm trying to decide what to do with it anyway.
Mm-hmm.
Dave, I was just going to add, I think what probably Assemblywoman Pellerin's office has heard, what I've seen, people are getting dropped in the urban environment right now. So this notion that like anything in Bonny Doon that you do at your home level is going to change their evaluation of your home in a renewal/non-renewal is probably right now pretty unlikely. They're just culling and reducing their total volume of policies in any given area. I've talked to community members on SoCal San Jose who have a risk score of 1, the lowest risk score, and they got dropped at the end of a cul-de-sac. We have people, I've talked to people who live in an urban environment. Their neighbors, they all got dropped. He got dropped. He had 500 feet of defensible space, and his neighbors had, kept their policy and were at a higher risk. So it's somewhat arbitrary right now. So I think, yes, there are things you can do, but people are getting dropped everywhere inside the city limits of Santa Cruz, inside the urban services line. It's happening regardless of what you've done to your home right now. Maybe it'll get better over time.
Yeah, thanks. That was a really informative set of answers. The next question is for Assemblymember Pellerin. Assembly Bill 2416 would have rewarded homeowners with insurance discounts if certain mitigation efforts are met, and Senate Bill 1060 would have required insurers using risk models during underwriting to account for mitigation efforts and require the California Insurance Department to make reports and evaluations available to the public. Can you give us any insight into why these bills did not pass? And I think more importantly, if there will be any similar legislation introduced in the future.
Well, it was not a stellar year for legislation in this area, primarily because we have a commitment from the Department of Insurance to do it through their regulatory means. But that the Connolly bill, AB 2416, died on the Senate appropriations file. So we got it out of the Assembly. I supported the bill, but it failed on the Senate side, probably due to costs because it was a very difficult budget year. My understanding is that I'm hopeful that Connolly will take that bill up again this next year. And then the other bill, the Becker bill that you referred to, passed the Senate and got over to the Assembly, but the author canceled the Assembly hearing. So I'm not exactly sure why he chose to do that, but I could definitely follow up with him. There was another bill too by David Alvarez, AB 2996, that would have authorized the California Infrastructure and Economic Development Bank to issue bonds to help reinforce the fair finances, and that one did not move either. So it was a frustrating year, but I think we're hopeful that the plan that's being put out, the SIS and the regulations that are coming forward at the end of this year will provide some better responses to this crisis. But we're prepared to come back. Our working group is still alive and well. Our insurance committee chairperson, Lisa Calderon, held a hearing in September 17th to also do an oversight hearing and drill down on these issues. And our working group is prepared to introduce legislation when we start back up again in January.
Okay, thanks for your answer and thanks for your efforts. And I think there's still 110 participants online who are glad to hear that you're still working on that.
Still working. We're not giving up.
Well, the next one is a topic that's been a big issue in Santa Cruz County for the last 6 months or so. For the past 2 decades, recreation's been the single largest cause of wildfires in California. Santa Cruz County recently rejected a county proposed ordinance that would have allowed unsupervised camping on more than 1,000 parcels covering tens of thousands of acres, including in areas mapped as high fire hazard and by CAL FIRE. The state law SB 620 would allow such camping in counties that approve it. If Santa Cruz were to someday approve a county LICA ordinance and the state SB 620 was in place, what impact could the increased fire risk imposed by LICAs have on the ability of hosting property and their neighbors to obtain and keep fire insurance? And that's probably a question for anybody who has any vision of how that perceived risk would affect the insurance policy underwriters.
And let me just say on SB 620, that bill was held on the Assembly floor. I worked my colleagues and talked about the concerns, and this of course was the Senate Majority Leader over in the Senate, but he just did not have the votes on the Assembly floor to get that out. So we were able to stop it.
Yeah, thank you. And any guesses about would that impact insurance rates in a county that approved LICAs compared to the same county not approving LICAs?
I'll just venture a comment, as I was also an underwriter before I worked for the Department of Insurance. I don't know that it would change the premiums unless there were fires that occurred and caused losses, but it could very likely change or eligibility for coverage.
Okay.
For adjacent properties. Dave, I do want to take a moment while we approach the October 15th transition in people being able to do pile burns, that it's also very important that people take the responsibility when they are doing pile burns on their home to take the necessary precautions and be careful there. We've had more instances of those types of fires getting out of control in our community as of late. So I just want to remind folks that hazardous fuel reduction is very important, and we all want to do it responsibly.
Okay, thank you. Okay, moving on to the sustainable insurance strategy. The sustainable insurance strategy lists Santa Cruz County as distressed, but the county zip code 95060, where more than 250 homes were lost in the CZU fire, is not listed as distressed. Does this mean that the properties within 95060 are excluded from the effort to enforce insurers to resume writing policies in high fire risk areas?
I believe I was told, and Lizette, please chime in if I'm wrong, but our district director, Maureen McCarty, has been working on this, and I thought she got some information that they were looking at the entire county as distressed, but she's really our expert on that one.
Okay, maybe we'll have to follow
I know
up
she's working on it, and we've been talking about this often. Yes.
Okay, because it is an issue which it is for Bonny Doon in particular. Okay, let's see.
And yeah, and Lizette just texted me that yes, that's what Maureen told her as well, that they're looking at the entire county as being distressed and not just zip code.
Okay, here's another question for anyone. Consumer Watchdog claims that under the proposed state insurance plan, insurance companies won't have to expand sales to 85% of consumers in distressed areas. They may opt instead to increase their market share in distressed areas by just 5% or choose a third undefined alternative commitment. Consumer Watchdog also claims the insurance companies won't have to sell comprehensive coverage. They may offer a bare bones policy equivalent to the FAIR plan. Rate hikes would start on day one, but insurers wouldn't report progress toward commitments for 2 years. And after 2 years, an insurer may put off meeting a commitment indefinitely as long as it claims to be making a reasonable effort. There are no penalties if a company fails and no timelines. So the question is, I read this in the Consumer Watchdog website, and then I looked through the 28 pages of the proposed new insurance legislation. And frankly, I'm not a lawyer, and it was beyond me to be able to tell whether Consumer Watchdog, whether those claims are correct or incorrect. So the question is, have you looked at those complaints, and are they founded, or is it just made up?
Edan, Cassidy, my attitude would be Consumer Watchdog is a large reason that we are where we are right now. I wouldn't necessarily trust their opinion on this. They're definitely partisan, and their free lunch for being the intervener of choice in California is coming to an end. The buffet is closing. So
yeah, I saw that they on their website or an article about them explained how they were pushing for the 103 legislation that did cause a big part of this problem.
well,
But I didn't know enough to know if these claims were right or wrong. Thanks.
They spearheaded 103 in 1988, and it benefited all of us Californians in a huge way. And we should be, I know it's hard to hear, but we should be happy that we pocketed 3 decades of immense savings over the rest of the country opposing the insurance industry, but it's over. So
yeah, I would add that I think I said exactly that same thing Eden just said in Scotts Valley. And so I don't really want to put Consumer Watchdog down. They've done a lot. I do think that there are some weaknesses in the regulation in terms of enforcing the requirements to add business. And really what the regulation does is trade off, the ability to use wildfire risk models to project losses to enter into their rates. If they agree to make this quid pro quo of writing higher risk business, if they fail in some way to meet that percentage, it's going to create the challenge of telling the insurer, okay, you haven't met the commitment, so I'm going, the department would say, so you can no longer use those wildfire risk models. It creates the possibility that the insurer will then non-renew all the expanded business it wrote over the couple of years because it had the model. So the regulations have some issues in terms of trying to enforce them, causing additional problems, down the line. So you may leave them unenforced, because you don't want the non-renewals to start over again by pushing the insurer back to the current catastrophe adjustment in the regulations that isn't forward-looking. So I think it's a little bit problematic of what we've got, and hopefully insurers will honor their commitment, but maybe some strengthening components will be put into the regulations to make it so it's not a flip-flop between using models or the catastrophe model, but something in between that, keeps the market more stabilized. It's very complicated problem. And so it's tough for just anybody to sort out, but, we're going to be entering a new era in rate making, and, the commissioner's trying to get, a little more skin in the game from insurers for giving them this opportunity compared to current regs, and I understand it makes sense to do, but we're going to kind of have to tighten the framework up so it doesn't end up that insurers don't have to honor their commitments.
Yeah, if I might, I think I have some agreement here. Sorry, Julia, Julio, do you want to go?
Yes, if you don't mind.
Please, go ahead.
I just wanted to add one more thing to that is, the way that it is set up is that it's 85% for, all insurers, but the large insurers and also small and medium companies that may not be able to do the 85, they wouldn't physically or be able to do this. And so the 5% that we're looking at is very much so for those individual small companies that will not be able to do it, the way that it is set up right now. So we would be working with each insurance company to make sure that they do take their, do their part in this as well. So I just wanted to make that distinction so that we don't just think that, oh, then everybody's going to just say, we're just going to do 5%. It's like, no, this is very much so. It's going to be on an individual basis, and it's very much so going to be depending on the size of the company as well and what their capabilities are.
Yeah, if you don't mind, I'd even.
And the expectation is that they, that we will have a lot more insurance companies than writing and in the in the game, so that there will be a lot more there will be a lot more interest in trying to then insure those homes that are mitigated. So even though you might not get your discount immediately or, any of that, I really, would, implore you to do your part to make sure that your home is mitigated, because in the long run, what that's going to do is it's going to help you to make sure that you'll be able to have insurance companies then buying for your business, which is, completely separate from what is happening right now that nobody wants to sell. So the expectation is that as that changes, if your home is mitigated, and if you have done the work to make sure that you continue to keep your home mitigated, that you will be one of those people that if you are in the FAIR plan now, you will be able to be taken out of the FAIR plan and going into the regular market.
Yeah, if I might, I know you probably want to move on from this, but I do have to say, I think I'll be a little stronger in saying that what Consumer Watchdog is saying there is really incredibly misleading and a misappropriation of facts. And it's very disappointing. To Mr. Cassidy's point, it seems like they're just unwilling to contemplate any real solutions. All they want to do is throw hand grenades here. I spent a lot of time on this regulation. I got it in front of me right now. I'll tell you exactly what it says. So you have to meet the 85%. You can alternatively do a 5%. I think, and if you look at really the 300 pages of initial statement of reasons that the department's put out there, they've done an extensive analysis of the market and what they call earned exposures in each zip code. And basically what they're saying is, and I think to Ms. Juarez's point too, is you've got insurers that have different circumstances going on. So you don't want to stop an insurer. Like, let's just say you had USAA, right, which they have a constraint, they write to military families. So let's say USAA wanted to grow, they wanted to add 15,000 policies. They wanted to take it out of the FAIR plan, but they're constrained because they can only write to military connected families. So they can do 15,000, and let's say that gets them to 82%. Do you want to say, no, we don't want you to take 15,000 people out of the FAIR plan? Is that the flexibility that Consumer Watchdog wants to take away from the commissioner? If any insurer, and I just testified at the regulatory hearing last week, and what I told the department is, you always have the authority to disapprove a filing. You should give yourself as much flexibility to tell an insurer, to Mr. Laucher's point, tell us how you're going to use cap models, tell us how you're going to use reinsurance, and tell us how many people in these distressed areas you're going to write and take out of the FAIR plan. And if you're going to move the needle in a meaningful way, then I think the consumer is better off, and everyone should be pleased that the department can do that, right? So why hem yourself in with some artificial numbers when the point is, here's the goal that you want to achieve. The idea that you would somehow limit it so that people who can't do it, can't participate, is foolish. And then on top of that, this idea that, oh, the rate increases start now, but the thing doesn't happen to 2 years. It's so ridiculous. Like, if you understand anything, right, understand you don't start to bring the people in before you get your rate filing approved. So it's like they don't even understand the process they're talking about, right? You've got to get the rate filing in place with the new pricing before you start making these offers. And by the way, the other thing that they're ignoring in this ridiculous comment that they're putting out there is, an insurer does not put a gun to your head and force you to take a policy, right? When the insurer does this, you as a consumer have to say, hey, I see you're taking new people. Here's my application. Then they get the application. They say, yes, here's our price. We would like you to come join us. If the consumer says no, what's an insurer supposed to do, right? They can't force people to come just because I've said I'm willing to take 20,000 people. I can't go around and say, you, and you're coming over to my company right now. So the idea that somehow the insurer on day one is going to be able to order 25,000 people to join their plan is ridiculous. It doesn't even connect to reality. So anyway, I'll leave it at that. We could do more deep dive on this, but the things they're saying are so illogical. And just to Mr. Laucher's point, I will say there is a maintenance requirement. The whole point of the reg says insurers, you have to hit this mark. You have to maintain yourself at that mark. You can't let anyone else go. And if you do a new filing, then you're going to have to show how you grow again or whatever else you do. But the idea is if you can get even, honestly, if you had even 5% plus for everybody, you get hundreds of thousands of people out of the FAIR plan right away. And you'd stop the growth and you'd get hundreds of thousands of people out of the FAIR plan. If
Okay,
anyone
I
did
think,
it,
no,
percent.
I think you gave a really a good convincing response there. We're about 3/4 of the way through the questions. I'm surprised how good progress we've made. If the panelists can hang in there, we've got the next batch of questions is on the FAIR plan. Are you game? We've still got 90 people online.
I'll give it till 10 o'clock.
I've got,
Oh, yeah, it's on there.
why doesn't the FAIR plan have cheaper high deductible options? Currently, the highest deductible is 20,000.
I can tell you to some degree, just as a general insurance statement, as a kind of rule of thumb, that insurers don't have massive deductibles sometimes available because they don't want to only hear about it when you have a $50,000 loss. To some degree, despite the fact that they would be on the hook for paying the loss if it goes above a certain amount, it actually allows them some control over the book of business that they are insuring. So if they had a lot of insureds having $10,000 losses and never reporting them, they would be unaware of the conditions of a lot of the insured premises, right? So they generally in insurance, just as a business, you want some level of deductible above which, if something occurs, you want to be made aware of it, right? You want to be made aware of how the repairs take place or if they take place. And this is just this is back to the underwriting days of mine, that you just wanted to, have a concept of what condition the insured building or business is in. And for that reason, you don't have deductibles that are outsized for the size of home or business you are insuring.
They also don't want to unwittingly allow the consumer to put themselves in a position where they can't afford to pay the deductible. Some people might say, I want a $50,000 deductible, and then a catastrophic claim happens. They can't come up with the $50,000. The home never gets rebuilt. It's
Exactly.
a loser for everybody involved. So
The other thing I'll share just anecdotally is I've talked to community members who have decided, and so when folks are deciding what level of deductible to have, where you live and in what environment is important. I've talked to community members who've had tree debris punch through their roof, cause thousands of dollars of damage. They fix it one year with the limited funds they have. It happens again the next year, and they don't have the money to fix it, because not everybody's sitting on 10 or 15 or $20,000 every year. If you live in the redwood forest and our redwoods are dropping limbs and punching through your roof, a high deductible may not afford you the ability to fix those things. So just some anecdotal stories of where people have chosen high deductibles and then been stuck in a tough spot because they can't afford to fix their roof because they've had repetitive loss below that threshold and don't have the cash on.
Yeah, that's why I recommend you take as high a deductible as you can afford to withstand the loss of, right? It is a challenge. And I will say, insurers that are made aware of every little loss can end up in a non-renewal too. So it's everything about insurance is a balancing act. between using that coverage and not using that coverage, and for the insurer being aware, like Evan pointed out, of things happening at the structure or them not getting fixed. So everything's a bit of a balancing act, and that's why deductibles, there's a cap on just how much an insurer wants to have as an unknown exposure out there.
Okay, a couple more questions on the FAIR plan. These were directed at Commissioner Lara, but I guess Julia, that means you, for sitting in for him. How does the commissioner see the role of the FAIR plan evolving, and what additional measures are being considered to ensure it remains solvent? Similar to the problems that Florida had after hurricanes. And then all of these are related, I guess. Financial figures for the current situation of the FAIR plan are hard to come by, and its financial situation rather opaque. I mean, this was what the questioner said. I haven't looked into this. What does the balance sheet look like for the FAIR plan in 2024? And the third part of this is, how are annual profits that are generated by the FAIR plan used? Do the net profits get distributed to the insurers participating in the plan, or do they get invested to build up reserves? Or does the FAIR plan lose money? I don't know.
If you want some assistance, Julio, let us know.
Well, go ahead, Seren. I mean, you all know that the insurance that, the FAIR plan was created by the legislature, but ultimately the FAIR plan is absolutely run by the insurance companies. And so, starting from the bottom up, on the question in regards to, if the FAIR plan then distributes the excess, let's say, that they collect back to the insurance companies, and correct me, Joel, if I'm wrong, but I believe that is the case, that they do give it back to the insurance companies. Now, what we are looking at is looking at different ways that we can work with a FAIR plan. The commissioner has made it one of the major issues that we tackle, and so the expectation is, through the sustainable insurance strategy, we are supposed to be working on getting people out of the FAIR plan, and so that is depopulating the FAIR plan is of utmost importance. Because ultimately, too, if there is a major catastrophe in the state, let's say 3 or 4 fires converge into one major disaster, then the FAIR plan would be, would have to be, paying out all of those claims, and then giving an assessment to the insurance companies, and so then the insurance companies would have to pay for that. So what we're trying to do is work with them to try to figure out, because then of course insurance companies would then have the assessment by their share of the market, and so we're working to try to figure out what can work, for this, and if there is a way that we can then make sure that there is, once the FAIR plan pays out everything, there is a way that we can help to make sure that this is taken care of. So I don't know if Joel and Seren, if you guys want to jump in and give a little bit more detail on all of this, I'm happy to give you the floor on that as well.
And yeah, I think that's generally correct. I will say just one point was, historically, the losses were assessed to the insurers and any gains were spread. I think that happened one time. But recently, I want to say this last year, the department took a policy change to say that the FAIR plan can no longer, if it has a profitable year, it can't distribute it to insurers. So no longer is that the case. It's not, and technically the FAIR plan, while insurers sit on the board of the FAIR plan, they do not run. It's a separate, it's state created, but it's an independent entity. with its own thing. So it's not run by insurers. And yeah, so that's essentially there is no profit sharing there any longer. And to Julia's point, yeah, the commissioner had a stipulated agreement with the FAIR Plan this year on improving the FAIR Plan operations, on expanding it to commercial, and then in addition, and expanding its HOA coverages, and then also trying to limit the exposures of insurers to just a couple of $1 billion rather than an uncapped $300 or $400 billion exposure, where it would look a lot like the California Insurance Guarantee Association.
Yeah, I would add that we're very lucky to have a FAIR Plan in California, because there have been several states that don't have such a thing and have had major availability of coverage issues, which can lead people to have to be foreclosed on their loan, actually, even, right? Because you have to have insurance in place. So California is very lucky to have FAIR Plan. The FAIR Plan has distributed millions of dollars back to insurers in profits over the years. So I'm glad to hear that's no longer allowed, but given the situation, I understand why it wouldn't be, because obviously the surplus is lacking given the current exposure. The department has been in litigation repeatedly with the FAIR Plan to get them to offer a homeowner's policy, kind of a stripped down homeowner's policy. That would be certainly potential big savings for consumers over having to buy a difference in conditions policy to get some of the key coverages they need on for insurance. So that is one that hopefully we can resolve someday and not make people buy two policies. But I definitely agree that the target goal today is to reduce the number of homes in the FAIR Plan to both, to the benefit of the industry, but to some degree, but that's secondary, of course, to the benefit of all the people who have policies in the FAIR Plan that would fare much better premium-wise and coverage-wise if they could get back in the admitted market, which is one of the primary goals, of course, of this sustainable insurance initiative.
Okay, we're really on a roll here, and between these answers and your presentations, I think we've cut it down to only 2 or 3 remaining questions. The first one of those remaining ones is it's related to agencies working together. I don't know, Dave, if you're still listening, you might be interested in this one too. Is there and Gail Pellerin, is there a role for the state to direct mitigation measures to communities that are identified as greatest risk? And could there be a database where insurance companies could know what local communities and fire departments are doing to reduce wildfire risk, other than having to fly their drones or drive the streets themselves?
I mean, I think we're working, at the county level with our state partners to bring as many dollars into our community to do wildfire risk reduction as we can. I would love to see a model where we're not competing with other more resourced counties for those precious dollars that CAL FIRE issues every year, and that there was a base allocation to certain communities so that we could start to build the capacity of doing the work with guaranteed funding rather than one-time or competitive grant funding. So it's certainly an evolving space. There are some ballot measures out there for the November ballot that hopefully will bring more resources to our state and our community for sure. I'll leave it there for now and hand it to Assemblymember if she wants to add.
Well, I also want to say in our state budget this year, we were able to get funding into CAL FIRE to do the maintenance that they do and the ability to get first strike and get their firefighters out there to address that. So we worked really hard to get money in the budget this year. And it was, like I said earlier, it was a pretty difficult budget year, but a statewide database, to my knowledge, does not exist, but it certainly could be a good idea.
Okay, thanks. Okay, now we're going to get to the last question right now. But first I want to thank the panelists who have now been on this call for 3 hours, including the half hour of getting all tuned into Zoom. I really learned a lot. This was great. Thanks. The last question has to do with the catastrophe modeling. The forward-looking disaster modeling that insurance companies would like to use is proprietary. Does the Department of Insurance review and approve those models or results before the insurance companies use them? And how would, let's see, if the models are proprietary, how will we know what the models are doing?
Department of Insurance is actually in the midst of hiring someone who is going to be overseeing all of the catastrophe models, and also we are working to make sure that we are on. We're going to be on top of all of that. In the meantime, the commissioner just announced last week that we have we have an initiative working with Cal Poly Humboldt to actually start looking at a state model. And start working on that to try to make sure that we are going to be able to oversee, not just oversee, their models, but then be able to work with our model to make sure it's a public model, to make sure that what is going to be used is going to be good for the consumers, appropriate and non-discriminatory, and when we keep in line with our mission to make sure that consumers are protected and that we continue to do that work. So yes, there will be different mechanisms in place to make sure that we are being as transparent as possible, but also being able to work with the insurance companies to make sure that we have the systems in place so that we can get the best for the consumer as we work on this. And at the end of the day, as the commissioner says, we are building the plane as we're flying it. So we're getting all of that together, and so there will be more information as we move along. But thank you all very, very much for your time. Greatly appreciate you having us, having the commissioner and us as well. So thank you.
Yeah, thanks everybody on the panel. And I see we still have 71 attendees. Many of our RBDA meetings don't even have that many people at the beginning of the meeting. So thanks everybody for hanging in there. Okay.
Thank
Have
you.
a good night.
Yep.
Yeah, thank you all. Bye.
Wow, that was excellent, Dave. Wow.
Thanks.
You got there.